Hello and welcome to this edition of the Market Share. I'm Paul Gifford. In our last Market Share, we were talking about how we thought that the markets and the pandemic were entering a new chapter. And we kind of put that into this picture that I'll show you here, where we show the economy really, which has plummeted and has started to recover, but you can see by that individual is looking ahead and there's still a wall of worry to climb. What we have to remember is that the market and investors almost always are worried about something. We've heard that from our clients, and we heard that from our colleagues. Both investors and individuals are looking for data to help reduce those worries and improve their confidence. And so today what I'd like to talk about is both the confidence of the consumer and the confidence in the markets. We're going to start with the consumer. As we get news each day, we get a lot of conflicting data. We might get some older data that might not be as good and doesn't represent current activities, such as progress on a vaccine or the current spike in COVID again, which is leading to regional shutdowns. We also get a lot of high frequency data, which is improving, but there's a lot of volatility week to week. So it can become challenging for individuals to be confident in that outlook, and that makes them more cautious. And with a more cautious consumer, that matters to the economy because they make up about 70% of it. We so far have seen that more cautious approach from the consumers show up a couple different ways. First, it's in the amount of cash. So we've seen checking accounts, savings accounts, and money market balances all balloon over the last 3 to 4 months. And naturally, the reason it's ballooning is we're seeing increasing rates of savings. In fact, the savings rate has hit all-time highs, which means that they're saving and spending less money in the economy. A second way we're seeing this is in the amount of outstanding debt. To go along with that spending less money, that's allowed them to pay down debt. And for the last several months, we've actually seen historic drops on an annualized basis in the amount of consumer debt, which is really interesting because consumers came into 2020 in such great shape. We had low unemployment, rising wages, and low debt service levels. Those are all good things and should make a consumer confident. But today we really have 2 of those 3 that are struggling, both from the rising wages and we have higher unemployment. So this is really the first time that the consumer is being challenged in many, many years. The consumer also has a third issue, and there's a set of consumers who today are benefiting from the extra unemployment benefits and also from staying on company payrolls through the Payroll Protection Program. Both of those programs' benefits are set to expire over the next several weeks. So we'll be very interested in to see how the consumer reacts in the next several weeks, but then also how fast Congress works to address a new bill to consider what to do with the drop in income. In the long run, consumer confidence matters. And just like investment markets, consumers have a wall of worry to climb. Now let's talk about the confidence in the equity markets. Obviously, equity markets are near all-time highs, so that's been really good. But we have to question the confidence going forward. The wall of worry that markets have to face include the economic recovery, earnings recovery, potential shutdowns regionally, and then in the not-too-distant future, elections. But let's start with the most current market issue to face us, and that's going to be earnings in the next several weeks. So there's been a lot of stocks that have done very well over the last several weeks. And what would be interesting to see is those winners' earnings going to be good enough to justify the stock market increase or not. Just likewise, the losing stocks, are those numbers going to be worse, or are they going to surprise and give a more upbeat outlook? So clearly earnings is going to matter in the short run. As a forward entity, the stock market might not worry about this next quarter's earnings, which is entirely possible, but eventually they're going to need to see a recovery in both the economy and earnings. And we really think that's got to happen in the next couple of quarters to continue to justify the current stock prices and any further stock price appreciation. As our team anticipates and watches and looks for answers to the question of confidence, both in the consumer and in investors, we continue to work hard each day to make really good decisions to help you meet your goals. Thank you for the opportunity to work with you.